This is the chart of DOW, the company, not to be confused with the Dow index. A clear horizontal range has formed to blur the boundary between a less strict double top and a concave triple top, with the second downswing slightly lower than the first and third. A larger bearish reversal has been left behind as the overall range is surpassed, with a bullish continuation upon the break over 39. A pair of uptrend lines will provide useful guides to identify stronger support potential if there are large downswings in the future. Despite the strong bearish reversal, there will be firm support since trading is nearing the approximate intersection of the 38 to 39 range with the uptrend lines. This is a great example of a pattern literally stacked on top of another pattern. A declined double top's lower boundary reused the old 39 to 38 area that marks the upper boundary of the previous horizontal range. This provided extra bearish context to overcome the uptrend and the support when the 39 to 38 area reversed rolls. In addition, the bullish break in mid to late April was strong, but not overwhelmingly decisive as April ended with bearish spikes to mark the beginning of what would later become the declined double top. There was also an adequate bearish spike to break the uptrend lines on May 17th. A combination of decreased selling pressure towards June and contact with the major mid-30s support leads to mainly neutral and indecisive price action in the short term. The bearish tone was present, but only now with the current red spike does it become more apparent that the influence of the declined double top will weigh heavily on another strong area of support. In this example, support held as shown by excellent examples of lower wick rejection in mid-June during large bearish spikes on the 15th and 16th. Here is another instance of a more passive rise. Selling has decreased to near insignificant levels, while normal to low bullish volume is steadily taking advantage of the lack of bearish sentiment to form an early uptrend. There will of course still be resistance at the downtrend line. Sharp evening star price action forms through the downtrend line to mark a failure to develop the uptrend into a more significant recovery. Now, virtually all market attention will be focused on whether the lower boundary holds, as contact is still maintained with 34.30 despite the strong selling over the past week. A similar situation to late May in the short term, with the recent bearish overextension that has seen a steep drop give way to sideways trading and a drastic decrease in selling pressure, while bullish volume is normal to low. A bullish bounce at such a major support and after overselling is quite normal. However, that certainly doesn't mean a large uptrend is on the way for sure. The downtrend line from the declined double top is recontacted to revive bearish sentiment and progress a potential descending triangle. There are near perfect conditions for a descending triangle to continue the double top's downtrend. Bearish volume builds on the support base and downtrend line. While price action is volatile at times, price action is neatly contained within the boundaries of the potential descending triangle. It is of course not a 100% guarantee of a major drop, but the chances will be higher once there is a decisive close under 34.30. Perhaps under 34 to adjust the support level to accommodate the last upswing's low. In any case, a classic large red candle and volume spike would be perfect, as trading nears the end of this ideal bearish situation. There is the decisive break to even close just under the bullhammer low of the last upswing from mid-July, where support could have been lowered to more accurately outline recent developments. The current bullhammer is more of a short-term response to the rapid bearish acceleration. The big picture still points to a bearish continuation progressing, and the 34 to 35 range now reversing roles to offer strong resistance to any future contact. Interestingly, downtrend lines from the double bottom at the beginning of the example extend to mark a declined neckline range of a large head and shoulders formation. This would have been a challenge to spot during its development for most, mainly because it is a less common but strong variant. The gradual transition from long-term uptrend to long-term downtrend is marked with multiple sets of downswings that form the left shoulder, head, and right shoulder, rather than the usual series of 3 single downswings. The double top with the slight decline of its downswing points also makes a big difference in adding more bearish sentiment to the peak that is the head. Overall, this was a great demonstration of several patterns in combination to progressively develop and add bearish context. Later, when there is a major recovery, there is expected influence from all the previous markings. Most noteworthy is the 34 to 35 range that is still highly accurate, to even be reused as a key range in 2013, where gaps form directly in or near it. Back at previous highs, there is major selling pressure as would be expected upon initial contact in September. However, unlike last time, there is a significant drop-off in selling, while bullish sentiment gradually accelerates. This leads to 3 methods rising price action after moderate resistance from a failed head and shoulders. Although not a classic resting phase from a horizontal range in a bullish continuation, the failed head and shoulders followed by 3 methods rising price action acted in a similar way to produce a strong breakout over prior highs. The lower 40s area naturally reverses roles to provide major support. At the same time, uptrend lines from the right shoulder can be seen with influence on certain swing points. It is not uncommon for such uptrend lines to be drawn from a minor incline of the right side of a failed head and shoulders. When further highs are reached, there is a substantial correction due to the combination of a head and shoulders that completes with a gap down. The gap down will certainly provide useful levels to reference, especially with the closing price of the candle just before the gap and the opening price of the gap down candle. Interestingly, the candles that form the gap are abnormally large. Normally, it is common for the gap down candle to be large, but less common for the candle before the gap down to be large as well. Strong bearish sentiment is easily observed as the gap down is not filled, despite a strong upswing. This is due in part to the influence of the 59.25 level. Later, a more stable and promising uptrend begins after selling pressure drastically decreases in August, right on the prior lower 40s range, that still offers long-term support. This contributes to additional bullish sentiment from an inclined double bottom that completes in early September. The pair of uptrend lines proves to be very useful, as the tenuous break over 53 begins to fail in establishing towards the gap down fill. Theoretically, the lower black uptrend line will be stronger than the upper pink trend line because it is part of a clear chart pattern. In this case, theory isn't of much consequence, as increasing bearish volume easily breaks both uptrend lines. A shallow angle also originates from a declined triple top that marked the start of the major reversal into 2020. Overall, the uptrend line from the inclined double bottom was confined more to the short to medium term context, and was highly useful in marking the exact point where the moderate uptrend was reversed with the decisive acceleration of the declined triple top's reversal. Interestingly, even though the 34 to 35 range did not have any recent swing points directly on it, it did mark the site of a gap down open and some contentious trading during the uncertain and volatile period in early 2020.